Hi, everyone. Well, the precious metal markets lit up over the past few days. Silver's rallied almost $2. Gold, $40, $50. And last time we had Tavi here, that was what he was talking about. Tavi, welcome back to TradeGATEHub. How does it feel to finally see some of the ideas that have been percolating and has taken patience to
Yeah.
stay with manifesting on your screen yesterday?
It was great. Even though I think for us, what we're doing certainly requires a long-term mentality, and we need to see, 300 days like yesterday, I guess, to actually be happy. But but it was certainly a start. It's nice to see gold trying to get out of a consolidation pattern, and it has been for over 12 months or so. And I think really we are in a bullish flag. And technically speaking, I think once we get out of that, I do think we're going to break out of that in a large way, and that's going to be very telling soon. And once we do, I think gold is going to outperform a lot of other assets, including the one in the screen here.
Yeah, what a great looking chart. So, people who feel like, they didn't sell the top in the Dow or S&P or Russell and didn't buy the bottom in gold, $80 ago, $100 ago, or silver, but this gold to Dow ratio, it's just starting. And, a lot of traders, investors fall into the trap that if they don't catch a move at the inflection point, that they're late. And all you have to do is pull up an S&P chart and tell me up until recently when anyone's been late and hasn't been able to take advantage of a bull market all these years. So this looks embryonic to me, Tavi.
I agree. Yeah, it's certainly my 2 cents here. Certainly looks a lot more like the beginning rather than the end of a move. However, you can do that with other charts, by the way, Coach.
Can you structure a trade this way to have the right ratio of gold to Dow futures or a Dow ETF? How are you using this pair as a trade, and how do you execute it?
I have parts of this trade in the book. Okay, that's a good question, what you ask. First of all, we've been call it lucky or call it a lot of work looking at what we thought was going to be the most painful parts of the market, which we thought the overall market would actually fall apart along with that, which was technology and software. We missed the biotech side. Biotech has been performing very badly too.
Yes.
We did not have any shorts there. We shorted biotechs in the past, but that's a very tough position to have. But
they've been hammered. They've lost, I think a lot of ETF biotechs have lost 50% of their value from their highs.
Well, February of 2021 is actually not commented by a lot of people, but it was since February, we've seen a lot of things peak. ARK peaked. We saw meme stocks speaking. We saw Chinese companies speaking. We saw some crypto assets, a lot of crypto assets peak back then. And software has been, dismal. I mean, software stocks, if you look at, the majority of the weight that you have here in the S&P is technology. About 60% of that in the peak of software was about 60% of technologies, that the technology sector, and now has been in a downward trend, as you also noted. So we've been shorting a lot of software names in the past. Now we shifted our positioning recently. So we've been trying to really look for the best way of expressing the trade that you see in the screen.
Okay. All right.
The denominator of this, which is equities. Now we think the next leg to fall here will be on large cap, would be on the mega cap. And so we've been, short Apple, we've been short Amazon, we've been short.
That was a good one.
Yeah, we've been short the the indices right now, we're short the S&P, we're short NASDAQ.
Okay.
So we shifted a little bit, and we used to have shorts on ARC. We're not short ARC anymore, which has been a phenomenal short.
Wasn't there an ETF designed by the guy who was in the that movie, The Big Score, or whatever it was? One of the traders who capitalized on the housing crash. I think he developed like a contrarian fund to the ARC stocks that Cathie Wood was in.
Is it
Is that
Michael
how you
Burry?
did that? There you go. Yes.
I didn't even know that he was the one who constructed the ETF. So you know more than I do. But I was aware of the ETF, and no, I was just short ARC, and I was just short. Actually, what we did was, no, ARC has a lot of quality names too in their in our opinion in their holdings. So what we did is we went through their holdings and we picked the ones that score very badly in our models. We still do fundamental analysis. I know this is rare in the markets today, but we do fundamental analysis. And if you did it back in those days, you found companies trading at 60, 70 times sales in the software space that are now still trading at 30 times sales. But
yeah,
the
next wave.
Yeah, I don't think that's over, by the way. I do think they could rally at some point here, have a relief rally. I don't want to get caught up in those. Yeah. That's why we have been allowing those positions to, because the natural form of having those positions in your portfolio is that they shrink after they work. And so they've been shrinking, and we allowed them to shrink. We have added to a few names. Coach, I'm very focused looking at looking right now. Last time we talked, we had the Brazilian stocks. Yes. That was an emerging idea for funds. Now, the emerging idea on the short side, I think it's heavy balance sheets that will get in trouble with cost of capital, because the weighted average cost of capital on the equity and debt side is on the rise. And that is for a lot of reasons. On the debt side, it has to do with the leverage. It has to do with the actual interest rate of high yield beginning to perk up. Also, it has to do with...
Yes, LQD really was even weaker than the junk, than HYG.
That's right.
During this recent rout in the Treasury market. So I was wondering why corporates were weaker than junk, because you would think that high grade corporates people would hold on to them longer than the high yield market. But I guess people, wanted the higher yield. And I was always taught higher the yield, higher the risk. But high yield held up better than LQD. And I know a lot of people think the bubble this time, it's a debt bubble, but it could start in the corporate debt market. Okay. So, all right. So here we're looking at sovereigns, right?
Yes, that's right. Okay. I think we talked about this chart last time as well, and it's starting to play out more recently, which is the amount of issuances of treasury bonds and notes that I've been following very closely. We've had, this is going back to 1996, as you can see in the chart. And
great look.
I mean, I've never seen anything like this. I mean, $50 billion, call it, of bonds and notes. For those who don't know, those are more long duration instruments. You have some of the 7-year things too here, but a majority certainly has a lot of 10-year related and even further out in the curve. What I'm concerned about this is the fact that the Federal Reserve has been buying 40+% of this every month.
So that buyer disappears.
That buyer disappears. Who has been picking up the slack recently has been the banks. US banks have magically started to buy more than before. And I do think they're totally instructed by the Fed to do so, which is too bad for banks in general, holding this you
Too
know,
bad for our system, continually central planned and in a way, you could use that word
yeah,
manipulation by going out to find someone to be a bag holder.
yeah,
So the
and
Fed doesn't want to hold the bag. I actually think that the Fed, when they talk about the running off of their balance sheet, you know what? The Fed doesn't want to lose money on this huge position they have,
yeah.
right? I mean, they're there to also to make money, right? It's a private institution.
Um, so I'm of the view that ultimately the Fed has to be responsible for suppressing rates at some point. And so I, you know, I so I've been very focused in trying to capitalize on the rise of interest rates, which I said it was going to be a high risk of reaching 2.5% and 3% in the next 12 months. I said that back in October.
Yeah.
Didn't work for a while, and then now it started to work. I will stand by that trade. And once it hits those levels, I'm out of that trade because I do think there will be a lot of people saying that we'll reach 5 from there. And it's not that I'm not a believer of that, but I do think there will be an overwhelming attempt from institutions in general to really suppress interest rates at that moment. And there's no way around this, right, Coach? I mean, everything here is held up by one thing called excess liquidity. And excess liquidity is held up by low interest rates right now. Everything is justified by this. And so how in the world do we allow interest rates to rise unless it's naturally, which should be, well above 5% today, given where inflation is, given where issuances are, and the list goes on in terms of that. This is one of the largest bubbles in financial markets is the treasury market, but very few people acknowledge it. And the issue is the manipulation that happens very openly. I mean, the fact that it's just like, imagine the Fed saying they're going to be buying stocks, and it's probably going to happen at some point. I'm starting to think that
most of them have been buying stocks, only not for the Fed.
Correct. And yes,
for themselves.
from themselves. And that's wow. Right. I mean, learning about this has been, very eye opening for me as well. And I've, knowing how much compliance I have to go through every time I buy a share of anything, and those guys, buying left and right, it's just so wrong, I have to say. I cannot touch a few instruments, just because we're so involved, and it's very ridiculous that they're able to do that with no lockups. They can buy and sell whenever they want. That's just wrong.
Yes. Well, anyhow, a sign of the times of how things have really, even in what's supposed to be a fair playing field, which it never really was. I mean, there were always people that had advantage. But you know what? If they got caught, they went to jail. There's no deterrent for these guys. All they have to do is resign.
Yeah.
So anyway, that's another subject. But I can understand how you'd be worried about. We've never had more supply, and now the Fed's going to stop buying. China's not a buyer. I don't know who's going to be the buyer. So I guess the banks are the Fed's backstop now and bag holder. And the Fed probably says, well, we'll cover any problems you have with them down the road.
Well,
you think?
It's all fun and games until interest rates begin to rise, cost of capital starts to rise, oil begins to rise, food prices begin to rise, and you're caught up in this, one of the largest equity bubbles we've seen in history as far as multiples go. On top of it, we've got the leverage amount in the government side that is unsustainable at these levels, at the rising levels of interest rates. And so inflation is getting out of control for other reasons, separate from what most people have been talking about, which is so focused on the pandemic, which will probably be over in we're not going to be in a pandemic anymore in a few months, in my opinion. I think the markets is starting to figure that out too. Look at energy prices.
Yeah.
But the thing is, what's baked in the cake for CPI, and in this chart, we're just looking at the move of energy now after the end of, or right at the end of the Q1 of 2021. So that's what's going to be baked in CPI headline. It's not pretty. I mean, this is, we're talking 40% year over year on oil. We're talking 86% year over year on that gas. You can do the same with gasoline prices. The list goes on here.
Yeah, Germany had, I think, a record inflation rate released this week, Tavi. I heard someone talking about it, 13, 14%.
Well,
and for that to be happening in Germany with their history of the Weimar Republic, if it wasn't the euro and it was the Deutschmark, I bet that the Bundesbank would be tightening now.
Well, we're short the German bonds, and we've been short them since October, and same trade with Treasury. So what I found back then, for me, it was very eye-opening too, because I was looking at price producer indices all over the world, and I'll give you examples. Spain today is, I think, 30+%. Italy is about 25%. Greece is about 20+%. Germany, you just mentioned. Japan, we're short JGBs. Japan is north of, I think, the largest amount since in 40 years. So all these places that have been used as examples of deflationary cases around the global economy are now suffering from inflation. And the cost of capital in those places have been suppressed by central banks for many years. And central banks are now having to start entering a tightening mode. The only place that is not doing so is China. And, it makes a little bit of sense. We're seeing.
Well, they have the Olympics coming up.
You have the Olympics coming up. I posted a chart yesterday as well that for me is important.
So, guys, here's a great resource for you. Tavi's Twitter. Follow him. Go ahead, buddy.
Oh, thank you. The yellow line here is looking at China high yield market, which has been collapsing. I think other people have mentioned this. It's interesting, the strong link with equity markets in China as well, as you can see. Some folks have been asking me if, first, the CSI 300 is in CNH, in CNY, and the yellow is in US. The thing is, the currency has been in a tie band for many years. Trust me, I've been short that and wrong. And I know that very well. You can put any currency, you'll see the same divergence that you're seeing here. Exactly same, no difference. Very slight difference. The second thing I heard is that in today's market, the Chinese equity market is in a decline because it's been in a competitive market, losing capital flows due to crypto. Well, that is also not true, because the crypto market and Chinese market actually peaked at the same time in 2021. And I think we're seeing, the same exit is happening here. Personally, I think the PBOC better hope this relationship is broken. And otherwise, I think we're going to continue to see further, it's the only place in the world.
Yeah, and people are coming in now, Tavi. I bet you have people saying, some of the Chinese tech have had pretty good bounces over the past couple of weeks. In fact, right now, they're holding up better than the NASDAQ 100. So I bet you have a lot of people saying, well, China really got hit, but when I look at the blue line, it sure doesn't look like it felt like sentiment-wise. So people asking you, could I put a portion of my equity, my cash into Chinese tech? What do you tell them?
So I don't have a lot of things in that sense. For me, it's not all about money. There are things that are uninvestable. In this case, China, I just don't buy China. I know I've done enough research for over 5 years, not more than that. Very in depth. You can read all the letters. We've had even issues releasing some of our content with the PBOC in the past. Believe it or not, and you know, I'm tired of putting
Rules.
research.
Yeah.
Yeah.
Yeah. And them changing the rules midstream.
There's that as well. I mean, we've seen it all already in China. I think the best thing we could all do as fiduciaries is to, I think it's just having a kind of an Nassim Taleb type of strategy where you're short the Chinese currency with put options. You let it bleed every year. You know, you put in that trade every year. I think at some point you're going to see, I think at some point you will see a collapse of the Chinese yuan. I really have no hope on when it's going to happen, when it's likely to happen. I've used all sorts of indicators to try to figure that out. And unfortunately, I don't see it when. However, all the entire recipe of prior currency crisis and credit crisis in the past, I think China has all of those, you know, by far, and in some cases more than any other time in history. We're talking nominal terms, real terms. You know, over 300% of Chinese banks' assets relative to GDP. This is well above any other time in other bubbles that we've seen in the past, from the housing bubble in the US to European bubble prior to 2011 to Asian crisis back in 1997. A list goes on. I mean, this is real, real problem that very few people are paying attention. A lot of it's in real estate. And China has been able to hide very well because commodity prices have been very low. Now things are changing. China is one of the emerging markets. Call it. Some people may get mad at me because I call it an emerging market. Whatever, call it whatever you want. But if we put,
I have your back, Tavi.
What's that?
I have your back if anyone gets mad. All right.
Okay. Thank you very much.
Buddy.
Yeah. My view is that for capital allocators, you have to be looking at what type of economy you want to own. I think you want to own economies that are commodity producers, not commodity importers. Brazil falls in that category, as I said before.
Before we get to Brazil, Tavi, I did see a headline. In fact, it was in the main chat at TradeGATEHub about China warning the U.S. about raising rates, like a warning, like they're trying to dictate Federal Reserve policy. They gave, I don't know what the repercussions are going to be from China with the Fed tightening, but I thought that was a pretty strong statement for them to come out and tell us what we should do with our monetary policy and not to raise rates. Did you see that?
You picked up on something that I think it's also, there's certainly something that called my attention as well. The tensions.
What are they afraid of here?
Oh, 100%. And I think they're finally having a problem that they have zero control over, which is a commodities market. And a lot of people have been wrongly thinking that China has full control over commodities. However, when you think about it, it's almost all the way around. In order to keep up with the nominal GDP growth that they report, they have to be buying commodities. There's no way around this. And so who owns who here? I don't think it's the other way around. I really think commodities have the lead here, and commodity has been suppressed for many, many years, allowing China to be developing as much as they did, allowing China to have the infrastructure boom that they had for so many years. And I do think that that's over. I think that that's, you know, we're at the beginning of a real bull market for other reasons, for reasons of, on the supply side, first and foremost, for reasons of electrification and green revolution happening, for reasons of assets that have been suppressed for so many years relative to others like equities. Just look at commodities to equity ratio, a 50-year low.
Yes.
People ask me, well, why don't you own, sell off in NASDAQ? Like you just said about Chinese stocks, why don't you start buying some tech names? Look, I'd rather own that. I'd rather own copper than own NASDAQ. I'd rather own copper than own Chinese equities. I'd much rather own Brazilian equities than own Chinese equities. It's simply uninvestable, and I don't want to touch that at all. And
Okay.
so,
So you're slightly negative on China here, Tavi.
I just want to note that I'm not shorting Chinese
Yeah.
equities either. I
Right. You're
acknowledge
saying it's in the void for you.
I acknowledge the fact that I was short in the past, and I acknowledge the fact that now what's happening is China is one of the first larger economies, more relevant economies in the world that is having to deal with, should we tighten monetary policy to fight an inflationary problem, or do we have to lose monetary conditions because of the credit crunching that we're having due to some property developers, some other issues in high yield markets?
Is that it almost sounds like that could be a foreshadowing of what could happen here.
Absolutely. Yeah. I mean, all central banks are trapped. The thing is, China is having to deal with it now because they're much larger importer of commodities than any other economy in the world. And people saying, I want to own China, you're basically shorting commodities in this case here. I think there's no way China can be successful in a rising commodities market. I'm talking about long term, 5 to 10 years. If you think commodities are going to be on the upside, not the downside, why own Chinese equities? I really don't understand that. But again,
okay,
I do think that there's a risk of, I think they're going to resort back to liquidity, and maybe
they're
Chinese
signaling
equities could potentially rise on that signal.
Yeah.
Look, I don't have to have a strong view on everything in the market. I
No,
really
you don't
have. Yeah, I'm sitting aside on that one.
Yeah, your positions speak your views.
Yeah.
And you know what, Tavi, I tell this story all the time. I knew guys that never left the live cattle pit at the CME. And that's all they knew. And they knew it like the back of their hand. And they were masters of one market. It doesn't take a portfolio to be successful.
Yeah.
It takes mastering a few. Don't you think?
I agree 100%. You got to stay where you think you have a niche. You think you have an edge. That is why we own over 80% of our long assets is in properties that have gold and silver in the ground. That's a major reason for that. We do think we have an edge in that part of the market. But look, if I try to do the same strategy in software companies, there's plenty smart guys trying to figure that out. I mean, there is a lack of geologists and a lack of real expertise to navigate a market like that. I can name maybe less than 5 people that could perhaps, really navigate the exploration side of the market today. Not even the majors know what they're doing. In fact, they're not doing it all. They're just waiting to see successful stories to then buy them out. And so
even like guys like McEwen now, and he was people used to bet on the jockey when they bought miners, and he had a big following until he started diluting mucks. So so they come and go, don't they? The leadership in the mining industry.
Oh yeah, there are a few people that are more credible over the years when it comes to finding deposits. And finding deposits is it's like managing a portfolio. Some people really bet on one story, and what we found is, why bet on one story? I mean, why not take an approach and buy 80 companies that are likely to succeed and see how that goes? And I think being up 15% in I'm not trying to sell our fund, but being up 15% on a down market for gold in 2021, it's just, imagine what we could do in a bull market. So I'm very, very focused in this strategy. But the chart you're seeing in the screen, because you mentioned cattle traders, and I'm buying cattle now.
Okay.
I think
all the grains, there used to be a war chant, beans in the teens. They've been in the teens forever. They're going to have to find another one that rhymes with 20s. So the grains and Tavi, what is tightening going to do to stop this breakout from continuing to advance?
breakout in agricultural
DBA,
commodities.
like what we're seeing, the chart we're looking at right now.
Oh,
You have a trend break. So if the Fed goes ahead with, now they're talking 6, you people talking 8
yeah.
rate hikes, and that they're the March meeting, they're not going to go a quarter, they're going to go a half. How will that depress things that are more dependent on weather than interest rates?
Coach, I think in general in the markets today, there's a total lack of understanding of what is necessary to fight an inflationary problem. Maybe because we've been in, so many decades already of disinflationary forces.
Yeah.
And so
we've been spoiled
yeah.
of having a glut and plenty of everything.
Yeah.
Yeah.
Policymakers and market participants have lost their way trying to understand inflation, and they gave up. And what's happening is, the truth, in my view, is that in order to fight inflation, you don't take interest rates to 2%. Who cares if they're going to raise rates 8, 10 times?
Yeah, is that going to grow more beans?
Points.
Is that going to grow more beans or less beans? Nothing.
And it's 25 basis points.
Yeah.
25. I mean, if they raise 10 times, it's not even enough. So we're talking a very small amount, overall amount. I joked around, but I said the other day, it's a good thing that the Fed is thinking ahead of time and thinking about raising, having interest rates at 2% to then start fighting inflation. But, look, Brazil had to take interest rates from
to
basically
50.
900 basis points
900.
in less than a year, or less than that, but a little less than that. But it's, the comparison.
So, okay, Tavi, this is what I'm going to do. And you know what? I really would support you. I'm making you the Fed chairman. And we have this inflation problem. And as Fed chairman, what's your policy now?
Wow. You're asking me to be a policymaker, and I spend zero time thinking about what I think should be the prescription here.
Okay.
And I think about, my brain works on what are the consequences of everything, positive or negative, and the impact in the market. There's no policy you could do here to fix the problem. I mean, you're basically telling me, here's a trap situation, now go ahead and fix it. I can't fix it. Nobody can fix it. We're levered, to the guilt here everywhere here in the US. Corporations, on top of, median S&P today in terms of debt to assets ratio is way above where it was in the peak of the housing and the peak of the tech bubble. Government debt is a much larger problem than it used to be in the past. The tax policy is not following that. We've seen this in the past, and tax policy back in other times when government debt was at 130, 140% of GDP. Well, tax policy in the highest tax bracket was at 96% in the 40s. 96, it's at 40 today. So the difference is, in terms of how aggressive things are today relative to history, is this is the most aggressive
unprecedented time.
Yeah. And then so thinking about your other question, which was, how do you stop the chart here from breaking out? You can't. It's just impossible. You can't. Maybe if you do more than the market is expecting, this thing can get a pullback of 2 months, a 3-month pullback. In the worst case scenario, you get a gold market that goes sideways, basically for over 12 months. But then you have all these other commodities breaking out. You got lumber prices going out of control. You got natural gas prices. You got oil. You got zinc, lead, tin, coal prices. I mean, everything else is going up. And so I'm very bullish on this chart. I think the risk for a food crisis in the next 12 months, been saying this for a while now, it has not happened. And I'm the first one to stand behind that idea. I really think there's a high risk of that. I'm owning anything that is tangible today that has not moved as much yet. And I think agricultural commodities is one of the parts of the market that is still ripe for a major move. Food prices will be impacted by that. I care about that because it's not about the CPI. I'm fully aware the CPI has a very low percentage in food prices today, even though agricultural commodities would impact the entire market. However, I think this is a real concern for what is actually your basket of spendings if you are a bottom 50%. This is a real problem if you have food prices rising. We're seeing all the signs of that happening here. And for me, the next step is this chart's going to break out even further. I think cattle prices are very interesting as well. Feeder cattle is interesting because it's lagging a little bit. There's quite a lot of things you could do in order to copper has been consolidating, coach. I mean, it's been, quiet since May of 2021. We bought copper recently here. We think copper, could break out. So there's a lot going on.
There is anything tangible. And, I share your concern about food security and, and grains are not affected by Fed policy. Unless they want to take us into a depression and people can't afford to buy food.
Yeah.
And then it would have some impact, right? Or there isn't food around. So, I really appreciate your passion for what's going on here. This is going to be a very important period for people that have been lulled to sleep because of the last 20, 30 years of having a deflationary, disinflationary environment, commodities, plenty. You could just have anything you want in 24 hours by just ordering online. And, I think that people have to buckle up their seatbelts and do just some simple things like, go out and buy some physical metal and put it in a coffee can. But there also are great opportunities like you're talking about if you're in the right stuff, because the worm is turning and the final worm to turn will be the dollar. Do you think the dollar has peaked or there's one more run left in it?
Well, the dollar is a tough question because it's the dollar relative to what? I don't have much of a view on dollar, euro. I don't have much of a view on those. I think there are commodity producer countries that could potentially do well relative to the dollar. I think the Brazilian real could do well. I've been struggling thinking about how to structure that trade of Brazil. I think, we've been buying more of the ETF and more of the commodity related names, Suzano and some others. I think there are, I think there's a lack of understanding of the political environment in Brazil as well, while a lot of people have been dipping their toes into that. And I caution a lot of people to understand that we're going to go through a very, very, perhaps the most important elections in history of Brazil.
When are they?
Which is going to be at the end of the year.
Okay.
And, we have on one side a right wing that we have not seen in the last, call it 30, 40 years to the degree that we see today, Bolsonaro, which has been losing some popularity recently, like any other leader in the world today that is facing inflation. So inflation is one of the biggest recipes for political change.
Sure. I mean, it was a big break for Adolf Hitler. The wheelbarrows full of Reichsmarks, and people would dump the wheelbarrow full of money and run off with the wheelbarrow. There is one other geo spot that seems pretty imminent. Any view on Russia? Looks like, President Biden said, well, they may just do a small incursion. I'm hearing things. I interviewed a grain person yesterday, Angie, and she's saying it's going to be a major event for agriculture because they're big wheat producers. Well,
something we've been facing a lot as a thesis is the fact we've had, in the 90s, many capital allocators in the mining space went back to unsafe jurisdictions, because there was a trend of unsafe jurisdictions trying to attract capital and trying to really make sure they had their ducks in a row to attract foreign investors. And so we saw a big move towards that back in the 90s. Then we saw the opposite move after that for many years. And what's happening is the political effort in ESG is mostly happening in developed economies. If we're going to go through a true electrification process, we all know that we don't have enough copper, we don't have enough base metals. The list goes on. We even don't have enough oil to make that transition right now. And so in order to do that, we need those minerals. And interestingly enough, while there are places like Canada that could perhaps continue to be great places for those natural resources, I think there are some other more unsafe jurisdictions that may actually emerge to be potential winners here. We have assets in Brazil, we have assets in Bolivia. We got out completely, mostly of places like Mexico. So very, very selective on where we want to stay. And usually it hasn't much to do with the macro, and more with the uniqueness of the project that we think is capable of proceeding with the process of discovery and so forth. And so you're much more likely to develop natural resource projects in those places today, given the political effort in developed economies. Imagine developing something in Europe today. I mean, it would be impossible. I mean, it wouldn't happen.
Because of the security situation with Russia. I mean, that's what I was asking you about. What's going to be the market reaction on a Russian invasion?
Look, I think historically, I don't have an edge in that thought, Coach. So don't take me very serious.
No, that's okay. Only Nostradamus knows.
Yeah, I think historically, from what I've seen in Russia, is that they're very good at creating attention for something in order to do something else. I wonder if that's the case here. In other words, I think we're all looking at that, and there might be something else that they might be trying to orchestrate that nobody's aware of.
Like Kazakhstan with their energy resources. That would call them in there.
I don't know what it is, but I think certainly we're approaching some significant geopolitical change that might not be what most people are planning on seeing. And so, and this is me just doing light reading on the case and doing research from history of Russia in the past and other incidents like this. I don't have any money on that idea, and
well, I tell you what, Tavi, you know what? I normally I go half an hour. I lost track of time, and I was going to start asking you about the Fed talking about a digital currency, but you've already been generous here, and really appreciate your views. And this is a very important interview that people need to listen to this and pay attention to Tavi Costa. I think it is going to save a lot of grief knowing not to be with the rest of the sheep in the coming years. And Tavi is a great shepherd of resources. So thank you, Tavi Costa, once again for edifying the TradeGATEHub community. Really appreciate you, buddy.
Coach, I'm always pleased to be invited to speak with you and talk to you here. So you always ask very insightful questions, and thanks for having me again. I really appreciate the time.
Learn from you every time, Tavi. Thank you very much. All right, so that's going to be a wrap. Remember, don't just count, the money you have in the bank. Get prepared for some of these things. Maybe you have some food storage. The Mormons may have had it right, where you have to prepare for an emergency and hope it doesn't happen, and get ready and put your seatbelts on. Thanks again, Tavi.
Thank you for having me.
All right, buddy. That's a wrap, everyone. Hope you enjoyed it. See you later.